Hudson Executive Investment Corp, or HEC SPAC, is merging with TalkSpace. The deal is expected to close later this year, 2021, where it'll go from trading as HEC Stock to Talk Stock, or TALK Stock. So what is TalkSpace? TalkSpace is one of the leading brands in virtual mental health. Think psychology or psychiatry, but done virtually, either over your computer or over, a smartphone. They have two fast-growing business segments that we'll get into. One is a direct-to-consumer app, effectively, and the other is by partnering with existing companies and health providers that need to have sort of this additional offering of mental health to include, to sort of fit their full menu when it comes to offering healthcare. TalkSpace is growing very quickly, guiding to nearly 95% growth in 2020. The question becomes, how much growth should one expect in the years ahead? Because they certainly had a COVID bump in 2020. I like TalkSpace's setup. It's a promising company, and the healthcare industry needs a dramatic revolution with better care, lower costs, more outcome oriented. And that is a lot of the elements that TalkSpace is bringing to the table, along with some creative solutions that sort of improve how current therapy could be done, making it easier for patients to get therapy, higher utilization rates, potentially even better outcome rates. Journey subscribers know that I personally invested in HEC Stock, which is another telemedicine play, in October 2020. And then as of today, as of the date of this video, stock's up over 100%. The warrants that I invested in are up nearly 600%. So I know that the telemedicine, telehealth area, this field is ripe. It is ripe for potential. It's ripe for disruption. It's ripe for fast growers. So the challenge, however, is that you can find these fast growers, you can find these really interesting, potentially disruptive companies, but I'd argue that you also need to find these companies at a reasonable price as well. They don't have to be profitable right now, but you need to be able to think about, well, what's the right valuation for this? And honestly, I'm not sure TalkSpace is there. I'll walk through the full valuation at the end of this video, but this is the quick recap of what I think of TalkSpace. The valuation is just a bit ripe or too rich for my taste. So I'm not interested in pulling the trigger, and I'd also want to watch them execute more in the future. This video goes out to Samad, Pranav, Dave, Milo, and Aaron, who are all Unrivaled Investing Journey subscribers, and this actually goes out to all Unrivaled Investing Journey subscribers. What is that? A quick 10-second plug, if you will. So, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments, hence the name of the channel. We're trying to find companies, potential multi-baggers, types of stocks that can go up hundreds or thousands of percent. So if that's the type of thing that you like to learn about, make sure you subscribe. If you're already a subscriber, that thumbs up does help the proliferation of these videos. And if you want to follow my personal journey as I'm looking for these potential multi-baggers, there's a lot of exclusive takes, potential multi-baggers that I don't post about here on YouTube. If you want to follow my personal journey, go to unrivaledinvesting.com, click on Journey. So let's dig in so that way we can understand a little bit more about TalkSpace. So in order to understand TalkSpace, you first need to understand the deal, because they're going public via the SPAC process, where Hudson Executive Investment, or HEC SPAC, is merging with TalkSpace. So HEC is how it currently trades. In the future, if the deal goes through, it'll be under the Talk stock. A lot of cash is being brought in. You got the $400 million plus from this the cash in the trust. You got another $25 million from the company as a forward purchase, and then another $300 million from a pipe. So this is a lot of money, over $700 million coming in. Interestingly enough, the vast majority of it is going to pay out existing shareholders. So that is worth calling out. I generally don't like to see that, I'd rather the cash be going to the balance sheet and accelerating the growth versus the insiders selling out. They certainly have better information than buyers do. There is about 250 going to the balance sheet, and the rest goes to expenses. Let's go through the rest of this so that way you understand what exactly is TalkSpace. And they sort of frame it, with these different bubbles here, but starting from its foundations, is TalkSpace was founded by a husband and wife team that saved their marriage by going through couples therapy. And they realized from that experience that therapy is dramatically underrated, and that with virtual care, you can start expanding it to the masses, making it easier for people to get, because so many people could benefit from having, whether or not it's psychology or, psychiatry treatment, some sort of mental health treatment to sort of check, make sure you're on the right path. And so since this husband and wife team realized that, they've seen over 2 million patients that have gone through their platform. They currently have over 39 million people that are covered through the commercial plans that they partner with, and we'll get into that in a little bit in a minute, because that's not exactly that sort of makes you overthink how many they actually currently serve. They do have 46,000 though active members, or that's how they sort of frame as active patients going through their platform. So this is by no means a small operation. 46,000 people, that's a lot of people that are looking for mental health, sort of going on the right track. They claim that they're the #1 branded virtual therapy provider. That's branded, saying we're #1 branded, that sort of has a squishy feel to it versus like we have #1 market share or we have #1 by number of patients. But nevertheless, this is a real company. This is a real platform. 2,600 providers, effectively physicians, psychologists, psychiatrists that are doing these telehealth appointments or telehealth sessions with these members, with these patients. So this is a real deal. And this is another part that I felt was a little squishy as well, where they said 68% of members saw improvement in symptoms. It's footnoted, and this, I believe, is tied to a study they did with a couple of different universities dealing with depression and anxiety, showing that doing some sort of text-based or some sort of tele-based therapy helped college students deal with depression and anxiety. And so seeing this 68% figure, I'm not sure how relevant that is to their entire base versus just a limited study of saying college students. That one was a little bit unclear to me, because college students, the stressors there generally are a little different than, as you get older, as many people who've gone through college know, as your eyes sort of get opened up once you actually have to start working for a living, and paying the bills, and the challenges are much. Getting an A becomes what's expected of you versus what's an option when you're in university. So what's the business model, that we're looking at with TalkSpace? And so at the end of the day, you have these two different segments. One is business to consumer or direct to consumer platform, where you can see they have a couple of different sort of tiers, the way they structure it, where you have Messaging Plus, where you can send text, video, and audio messages for $65 a week, and then they'll respond back to you later that day. Another is sort of a premium messaging one, where you get one live video session a week, where you do a live video chat with a physician, psychologist, psychiatrist, once a week. So this is presumably psychologist, because psychiatry is a whole separate other category where it's clear that it's $199 per consult and then $125 for follow-ups, and then $99 per week for Live Talk Ultimate, where you have 4 live videos that you can do in a week, but this sort of unlimited sending text, video, and audio messaging. And that's a very different approach of how I would say therapy has traditionally been structured, where it's, hey, let's set this during the week sometime, and it's something scheduled in advance, versus you're paying by the week, saying, hey, I need to send this message in that moment when I'm truly feeling this depression or anxiety or stress. I can send that message then and there, and that helps me get it off my chest. And hopefully later that day, I can get a helpful response from the physician that I'm working with, from the psychologist or therapist that I'm working with. And you can see the average member treatment length is 5.4 months. This is a big deal, because from the way they frame it is that most therapy sessions, they don't actually last that long. Most people don't want to actually follow through with what the therapist is suggesting they do. And so showing something at 5.4 months, it's saying this actually gets follow through, so you're more likely to get favorable outcomes. You're more likely to have favorable developments for the patient that's struggling with these mental health issues. And you can see it's overall, for what could be a debilitating circumstance, $260 per month for this therapy. So that does strike me as a reasonable, very reasonable cost for getting this sort of unlimited videos, texts during the week that you can send them. It doesn't mean you're going to be getting them back, but you can get it off your chest. And you could sort of structure it as if you need to have, I do need to have at least one live chat. So you can send your message and they'll send a message back to you. But you could structure it. So I like seeing how they're taking modern technology and not just saying, hey, let's just put a Zoom layer on top of it, and hey, let's a Zoom and a Calendly, set up when people are going to be talking. But it's saying, well, actually, this technology is great for sending video clips. So why not in that moment share? And then you get feedback later that day, and it doesn't have to be a live session. So it's an interesting thought, and you can see how it's grown over time from 20,000 active members or active patients to nearly 30,000 in 2021. So that, you did have a big COVID bump here, but as we'll talk about in a minute or two, they have seen pretty great growth across both segments, including this direct to consumer, over several years. Let's go through that second business component, which is their B2B2C, so their business to consumer segment, where they're effectively working directly with employers like Blackstone, Google, or Accenture, or with healthcare providers or insurance companies like Cigna, Optum, Humana, Aetna, where they will say, hey, we've got you covered. If a company uses our health plans, then this will be a mental telehealth option that we have. So this fits our needs. So you're providing a solution that we need when we offer telehealth. And so you'd argue that the critical part here becomes Aetna and Humana and Cigna are the ones that actually have the relationship with the end businesses that are employing them. So, there is that risk that they could get swapped out over time. So that's a legitimate risk of like, hey, let's swap out this mental health provider versus another. But you do have this direct to employer, which I would argue is probably going to be stickier because it's a relationship that you're already building with that company. But it does have a similar swap it out, hey, if we're not happy with this feature, and similar levels of pricing. Now, just by partnering with some of these insurance companies, and this has been a relatively new initiative for them, for this company's history in terms of this business to consumer, market, is that this segment, their growth has really gone from immaterial to very significant in terms of coverage, in terms of the number of people that are represented by the underlying insurance plans that they work with, where they've gone from approximately 2 million as of the first quarter 2019, 2 million people covered, total people covered under these different plans, to 39 million people covered. So of those 39 million people, they could use the TalkSpace mental health telehealth solution. So what's their value proposition that we're looking at here? And, there's a couple of things that are interesting, and I've sort of alluded to them already, where, what could make it better, let's say, than traditional therapy is the idea that it's on demand, it aligns with the issue in that moment, and the potential solution of saying, hey, this isn't necessarily, on a Friday morning when I'm scheduling my therapy, that may not be the best time for actually channeling what were the issues that I'm facing, versus in that moment capturing it and capturing how I'm feeling, the emotions, the thought process. And so they're saying this on-demand access aligns with the issue and solution. It also lowers the friction, so that way it's more accessible for people to get the mental health, the mental therapy, or psychiatry that they need. The multiple ways to access care, mobile versus desktop, easily done. They argue it's affordable pricing model, which makes sense. They're showing this weekly pricing, and it's tiered. You can structure it for how you need it. This is a key point here. These are all really interesting points. The matching algorithm and access to clinical network. This is a part that's super interesting. Is as they've gotten bigger and bigger, they are able to track the outcome, because oftentimes people, when they're done, they fill out like an exit survey of saying, hey, what'd you think? How'd you think of this treatment? What did you think of, this therapy provider? And so they're have the data to say these therapists, these psychiatrists did X, Y, and Z, and this resulted in a favorable or not favorable outcome for a patient facing, ABC problem. From that data, it effectively turns into like an Uber-like marketplace where you can see, oh, these physicians are best, whether or not it's, psychologists or psychiatrists, they are best at dealing with these types of problems. So you start actually having an algorithm or network that sorts it out, saying, oh, this is your problem. You know what? Our data suggests you're going to get the most favorable experience going with this therapist. Oh, you have depression, you should go to this psychiatrist. Oh, it's maybe you have an eating disorder, maybe you should talk to the psychologist. So it's a really interesting framework of, I would wonder how tough it would be from the psychology, maybe I'm being a little too empathetic here, but I wonder how challenging this would be from the psychology of the healthcare providers, let's say the psychologists and psychiatrists, to sort of get pigeonholed into these categories. Like, imagine you became the algorithm's de facto, like, hey, this person's great for eating disorders. And so literally every patient you got was someone with an eating disorder. Like, it might be like one Oreo is good, but eating a whole box, it's a problem. And you wouldn't want to do that every day. And so I wonder if that is a challenge with this model. But it does create secondary, really interesting ideas. And this is part of what I alluded to at the beginning of the revolution in healthcare, is that you do start seeing an AI machine learning driven platform. And this is something they've talked about, where as a patient talks about their problems and they maybe fill out a survey saying these are my issues, the AI that has seen these millions of patients that have already gone through, the AI will suggest, hey, this might be the appropriate course of action. It's entirely up to you, but this is based on the data of millions of patients through our platform that generally this is how we've gotten favorable outcome. Up to you on how you want to play it. So that strikes me as super interesting, where it's refining the algorithm based on how the physician reacts and says, you know what, no, actually we want to go via this point of care. Maybe it's a form of medication prescription. No, you know what, I'd actually rather use this than that. The key component here that I'd argue is about a better outcome and their point is that 44% in terms of in-person therapy sessions, 44% return for a second visit, i.e. the vast majority do not return for a second visit, whereas here most people do, 80%. So that means you're lowering the hurdle, lowering that friction, so that way people can get on the path to getting the therapy they need and ultimately getting better outcomes, which is what the healthcare industry needs. It needs better outcomes at better prices. So that's this whole setup strikes me as interesting for those reasons. But it's not perfect. You go to like the Google App Store and you see TalkSpace as a 2.1 rating review. And that's worse, admittedly, than what I saw on the Apple App Store. Apple App Store, I think, was 3.8 stars. But you see the same sorts of things where people just didn't connect with the right therapists, or they felt that, the app was trying to, milk them for money and they made it too hard to quit or cancel it. So, the app's clearly not perfect based on a myriad of 1-star and unfavorable reviews. That said, some people it clearly resonates with, where they're saying, you know what, the ease and accessibility here is significant and it did have a meaningful impact on my life. So I don't want to completely dismiss it. It's just that there's a lot of critics here and that's worth calling out when you're thinking about the value proposition of this company. But, despite the critics, you are targeting a huge opportunity, several $100 billion. And look, you're especially in COVID times where everyone has, different or unusual circumstances that add to extra stress. And at the end of the day, the general population is always dealing with a general level of stress. but that extra little bit might just push a certain percentage of the population, into a mental struggle, into a mental challenging state. And so, here it is. They talk about 17 million U.S. adults have had at least one major depressive episode in the past year. Not surprising, given that the COVID. So 17 million, is a large number. They talk about how the suicide rate in the United States is up 30% since 2001. That's another, it's a depressing fact. And maybe by having better, easy, once again, lowering that friction when you're in the thick of it, easily being able to send a video, could that help with core mental health issues? But, by taking this business model of accessibility using modern day technology to sort of transform therapy, they could potentially be targeting a much bigger opportunity, because they also call it 60% of TalkSpace members are in therapy for the first time. So this isn't, the majority of people using TalkSpace are people saying, you know what, I'd rather try it out using a smartphone, using my computer, doing a Zoom-like therapy session, because that accessibility, maybe that affordability. That's a really interesting data point for people to know when they're thinking about this, because it's easy to be dismissive, saying, you know what, no, this doesn't make sense. Like, you need to have a real conversation, really, sit and talk with the person, size them up with your own eyes. And it's very clear this is potentially a bigger market than what was previously targeted, just by the fact that 60% are in therapy for the first time. And they're saying, look, if you look at international and domestic, you're easily thinking about several $100 billion in terms of potential market. So when you're looking at a company like this, you're easily saying 5x, 10x potential easily, just because you're tapping into this huge market. The challenge, though, is that who's going to win? Who's going to win in a market? Because there are plenty of huge markets. Hey, like the oil industry, that's a huge market. The problem is that there's not one big winner in, let's say, the oil producers. There's, it's super duper challenging, because it's a very competitive field. It's a very rivaled field. And so that's the challenge. They show, hey, we have the highest brand awareness relative to competitors. Honestly, that's a lousy metric, and it makes me nervous seeing that that's what they're calling out. I would much rather see a metric of number of users or patients versus these other platforms. So I don't have a good feel that they're unrivaled. If anything, I would say, based on this data where they're saying, hey, here are just 4 of them that we think we have a better brand than they do, it makes me think they're competing with many different players. I've certainly seen that over the last year, as I've been researching telehealth, that this is a space that it has low barriers to entry, so more and more players are looking to get into it. So it's not clear to me that they will have the key attributes necessary to dominate a huge market like this, or will it ultimately become sort of a commoditized space where what they're offering is sort of table stakes that everyone else offers. That said, it is possible that they could potentially become maybe a merger target for someone else, but we'll get into that in just a second. It's interesting, once again, this brand awareness, they're effectively paying certain brand ambassadors like Michael Phelps or Demi Lovato, who both had their own mental health lapses in the past, or maybe even currently. I don't know much about celebrities, so this is outside my circle. But you're paying for these different brand ambassadors to sort of talk about, saying, hey, TalkSpace was helpful for me, it might be helpful for you as well. So what do their financials look like? What does this picture look like? So these are the two components. This is the first segment, and you can see it's been growing at a good clip. It's doubled from 2017 to 2020, going from 15,000 to 17,000 to 20,000 to 31,000. So it's doubled over 3 years, but a large chunk of that, I'd argue, is COVID. Now this is business to business lives covered, and so this is you have to see this 3 zeros, and that means you add thousands to it. So they've gone, and see, this is the challenge here, is it's a little deceptive doing, this is apples and oranges. This is people that are actually paying in a business to consumer relationship, versus this is lives covered, and they're saying, hey, we cover 40 million lives versus Last year, it was 6.7 million lives. And we're going up to 200 million lives in the years ahead. Now, I'm not sure if this is baking in international or domestic only. If they're saying this is domestic, then they're effectively saying, hey, we think we've won in the United States, because that's half the population, more than half the population covered. So what does this actually drive in terms of revenue? The challenge here is they also haven't broken out how these two segments contribute to revenue, which bothers me. I would like to see that. I don't know the unit economics of these two and how that flows to their revenue. Instead, they do a consolidated figure where they show revenue growth in 2018 was 61%. Then in 2019, it was 33%. That is a dramatic deceleration from 60 to 33. But then you have this dramatic acceleration going back up in response to COVID. Now that makes sense. Like, look, COVID was a period of dramatic hardship. I don't need to explain it. And so a lot of mental health issues for folks. So you're going to get a lot more, folks looking ahead, especially when you can't meet up physically in person. So this makes sense, 94% growth. But saying you're going to have 69%, 64, and 40% growth when just the year prior you were closer to 33, that's really tough for me to get my head around, especially when it's like, well, wait a second, you're not going to have that same bump, presumably, in March 2021 or April 2021, where utilization just went parabolic, where people are stuck at home and they're just going, they're losing it a little because they're like, oh my gosh, this is such a dramatic change for my life. This is so hard of an adjustment. I need to talk to someone about this. I'm not seeing why that should grow 70% off of what was 2020. Now, management's saying that currently, they're at a run rate of around 100 million plus, so that it shouldn't be hard for them to get to that 125. But still, it certainly, like, okay, if they're able to land 2021, why are they able to do it again in 2022? What's the why that when they had this dramatic deceleration in 2019? Is it a marketing thing? Like, I'd love to understand that aspect. Now, they are showing some interesting profitability trends, saying their gross margin dollar continues to go up, and then it sort of peaks in 21 and then starts going down again, which is not something you commonly see, especially in projections, unless, and this is where you have to sort of peel it back a little bit, where I think it has to deal with the fact that they're expecting to grow at a much faster clip here, going from 31,000 to 85,000 versus 40 million to 174. So 4x versus a little under 3x change, more than 4x change. And I think this suggests that having effectively offering the mental telehealth solution to these insurance providers or directly to companies is actually a lower margin business for them than the direct-to-consumer business. Hence, as this grows at a disproportionate share to this, you should actually expect gross margins to dip, go from 64 to 62%. Either way, they're not projecting particularly high profitability in the years ahead. This is 2023. And so, when I look at this 60, so it makes me think, okay, gross margins are probably going to stabilize somewhere in the 60s, in which case the flow through to the bottom line in terms of operating profits might be 20, 30%. It's a question mark. It's a question of, how much are you going to have to invest in G&A? How much are you going to have to invest in, R&D, building out your platform, or marketing expenses? So it's a question mark of what your end profitability could be. Could it be closer to 40%? I'm not sure. I haven't seen something where they say, hey, we think we're 40% plus profitability. So what are my thoughts on the valuation? This is the template that I'm using, how I'm thinking about how to value it currently. And this is part of my value proposition to my loyal YouTube viewers, where you can go to the description of this video and I'll have a link to this valuation sheet. You click on file, download, and you can play around with it yourself. And so based on the current share price, you got to use, looking at HEC's market cap on Yahoo or whatever source you're using, it's going to be wrong if you're thinking about what's this value TalkSpace as, because you have to use a pro forma share count for what TalkSpace will be after the deal's closed. And based on the presentation, they're saying it's around 200 million shares outstanding, which based on this $12 share price gets you to around $2.4 billion valuation. So then the question is, well, okay, so what's that mean relative to their fundamentals? I'm always using a logical framework. Could it go higher or lower? Of course, but I want to have logic that sort of drives my decisions. I sleep better at night relying on logic versus hype, let's say. And so you can see 38 million in actual revenue in 2019. They're guiding to 95% growth in 2020. Then, they were projecting 125 million in 2021. So I'm saying in the high case, they do, let's say 126 million, mid case 65% growth, and lower case it's only 60% growth. And look, if management is sandbagging their numbers, then you'd argue, what? This should be even higher. They should be closer to 80% growth, just like they did in 2020. But for me, I'm thinking 2021 is going to have some tough comps that they're going to have to do, because during COVID of 2020, you had this parabolic increase in demand. So what is the long-term margins for this business? Once again, as I was talking about a minute ago, with gross margins around 50-60%, here it is 60%. The optimized margin, I'm saying maybe 20 to 30%, maybe a little higher. So that's you can play around with it if you feel like I'm dramatically off. What's the growth rate in the years ahead? In my high side scenario, I'm saying 40%. My low side, I'm saying 20%, where you see a deceleration like what you saw in 2019. And look, maybe I'm being too conservative here. Maybe you should say, move this, make it 30% here, 35, and 50% here. So you can toggle around your assumptions yourself. But then, what's the valuation you want to say that if you grow at this rate on a compounded basis over 4 years, on top of this growth that they're sort of guiding to for 2021, what's the sort of profitability? And this is, keep in mind, an optimized profit margin. I'm saying this is what the company will be valued off of, not necessarily what they're generating. This is what they're valued off of. So that way, when you're thinking about your return as an investor, you can think purely based on what's the top line growth and the multiple versus what's the margin. If you sort of use a range of margins, it makes it easier for you to narrow in, okay, what's actually going to drive my return over time? It's my top line, it's my valuation change. So, here it is. The assumed multiples, I gave a very wide range, 20 to 40 times multiple. This 40 times, that sort of assumes 5 years from now, there's still a lot of hype for telemedicine companies, but it's not just hype. If they're actually delivering, if they're actually showing 40% CAGR in their revenue, that would be very impressive if they're able to continue doing that. Whereas if they're only doing 20% over the next 5 years, one could argue they would have a lower valuation as well. This obviously leads to a pretty wide range of valuation scenarios of 80% upside and effectively 70% downside. That's effectively a 1-to-1 risk reward, which isn't that compelling in my opinion. What are some of my summary thoughts as we're looking at TalkSpace? So broadly, I like what TalkSpace is trying to do. It's adapting treatment, therapy, psychiatry for the modern technology that might better serve patients, either better utilization, better outcomes, better affordability. So I like the idea of improving humanity, people with mental health challenges, with better affordability, better access, lower friction. That strikes me as a win. I like the idea of TalkSpace doing that and layering on cool things like AI and suggested, directing patients with certain problems to certain physicians based on a whole database of thousands and millions of patients. So I like that setup. That's certainly better than what a person could do, I'd argue, of saying, hey, I think this physician's the right guy based on this problem, and I only know, let's say, 50 physicians. Here, it's a database where you're literally dealing with thousands of physicians. So that's a really interesting, sort of that's something that would be much harder for an individual to do. That is a problem that's perfect for a computer. And this is clearly a huge opportunity that they're tapping into. But my main challenge is, despite tapping into this huge multi-$100 billion market, they're not unrivaled. There's a lot of players getting into this space. And this space is dramatically heating up. Many players have announced that they're looking to get into it or expand their offering. So, I mean, you could have some of the leading telehealth companies say, hey, you know what? Why don't we just buy TalkSpace? So that would be, I would argue, a favorable outcome. The fact that they're going via the SPAC route suggests that that is not what has played out so far. So you may have had one of these leading telehealth providers talk to them, and they'd be like, we think we can keep growing on our own. Your valuation's not high enough. So that's a legitimate risk, is those conversations happened, and now they're just going to heat up with competitive, so they say, hey, these telemedicine companies want to take share, and this mental health telehealth company wants to take share, and who's going to win, and it's not clear. The challenge also is, I'm not sure that their business model is set to win longer term. Is it possible that this sort of niche business model actually doesn't work as well as a comprehensive broad funnel healthcare model where you go, hey, I have telehealth through XYZ company, and I know that this company covers everything. If I need to get labs done, they'll direct me to where I need to go, and it'll be done in a reasonable way. If I need a primary care physician, boom, I can do that. If I need mental health. So I wonder, normally I prefer companies that are in a particular niche, but I just wonder if having a wider funnel, especially when you're marketing yourself directly to companies. Do companies like Google or Blackstone, yeah, they're working with TalkSpace now, but in the future, do they want to keep doing that, or would it be easier to have one telehealth provider that covers everything? And so I'm not sure if they can win this battle longer term. It's a question. It's a big question mark for me. And plus, seeing that decelerating growth in 2019 was a big concern. I'd certainly want management to talk about that in greater detail so I can understand why they don't think that's going to happen again, at least for the next few years. And based on this aspects, looking back at this valuation, and keep in mind, this is a logical framework that I used, and keep in mind, I'm saying a range of 20 to 40 times. I just don't find it that crazy compelling. It's just not that rich. I don't think this risk reward is that great. I want to find a situation where heads I can make a lot and tails I don't lose much. I want a win-win for myself when I'm looking at investments. And as an example, Journey subscribers know in October 2020, I called out HIMS, it was HEC Stock at the time, as my potential multi-bagger. I bought it for my own personal portfolio. And I also did a video on HIMS on YouTube as well, where I called out. So if you want to learn about HIMS, you can go on YouTube, or I'll leave the link below if you're interested. But this is the risk reward that I penciled out. And notice the range of valuations that I assumed was 20 to 30 times. Whereas here, I'm penciling 20 to 40 times. So I'm assuming greater upside in terms of the multiple with TalkSpace. And yet, here it is, the risk reward at that time when I was looking at HIMS was much more attractive. It was 200% plus upside versus only about 25% downside. So that risk reward struck me as super compelling, and that's the reason why I bought it. And since then, it's performed very well as people sort of caught on to it. Oh, wow, there's a fast growing company here, and the valuation seems pretty reasonable. Since then, as of today, the stock's up over 100%, and the warrants that I also called out that I was buying are up nearly 600%. So that's the type of multi-bagger that I'd like. Ideally, I'd actually prefer something that doesn't go up that fast, because it's like, oh man, the risk reward's no longer as interesting, in my opinion, versus, finding something maybe it grows 20, 30, 40% a year. But hey, don't look a gift horse in the mouth. And so, I call this out as an example of, I want to see risk rewards like this, where it's several 100% upside in what I think is reasonable downside. Of course, could it go higher or lower? Of course. But I just want a logical framework with reasonable assumptions that drive that. And, if you're interested, Unrivaled Investing Journey subscribers will be getting my next potential multi-bagger later this week, which is another one of these types of upsides where I'm like, hey, I think it's a couple of 100%. And on the downside, you know what, I think it's very reasonable versus the upside potential. And that's just one aspect of what I'm offering with Unrivaled Investing Journey subscribers. So you not only get this once a month potential multi-bagger that I'm calling out, just like I called out HIMS in October 2020, back when it was trading at $10 a share, but I also have a monthly update of my entire portfolio where you can see what I bought, what I sold, what I hold in my portfolio. I also have additional exclusive content like educational series, teaching folks like, hey, here's how I think about hedging if the market's expensive. Like how can you react if you think the market's going to drop significantly? And or how do you potentially find potential multi-baggers? And I also have a catalog of contents, and that's sort of how you navigate around all my exclusive content. That catalog of contents that lists all the exclusive posts, that's a Google document. I have it in the description of this video. So if you're interested sort of getting your feet wet, see what I'm offering, you can click on that catalog contents to see everything, including prior months, potential multi-baggers. And at the end of the day, just finding one potential multi-bagger can change your life journey. So if you're interested in following my life journey as I try to find these potential multi-baggers, go to unrivaledinvesting.com, click on Journey. And if you enjoyed this video learning about TalkSpace, please make a point of subscribing. If you're already a subscriber, that thumbs up is much appreciated. And thank you so much for watching.